Hello students. So, good afternoon students. Praising. Prem, good afternoon. Prem, what was the question that you had? You can ask the query now. Okay. Sorry, students. Now, students, here the next question. Now, this is a case study, this is the only particular area which has not been asked by the ICI, but they can definitely use this concept for the purpose of students. They can use this concept for the purpose of the MCQs and all. So very high probability and the chances are there that this particular concept could be used for the MCQ purpose, and therefore students, we need to be ready for the same. Fine, students. Now what exactly this concept is? So students, I think today one more lecture after this at 5:20 p.m. is there. Praising, Prem. And I think by then transfer pricing provision would be over. Then students, tomorrow I will do first assessment procedure and assessment procedure, students. Once that has been done, tomorrow itself we should be in a position to start with PGBP. Yeah, you can, because praising, every question I'm doing it and every question I'm giving the background. So there is absolutely no issues. Go ahead with that. Prem, you can ask your question in the meantime. That is fine. Now students, in the previous particular, this is a concept of multi-year data, students. Multi-year data. We have seen that comparables that we are getting, the information relating to the comparables on the basis of which we are determining the ALP, arm's length price. That information relating to comparable, students, one thing is very sure and one thing is very clear to us. Royalty replaces with brand value means? No, in that case, what here in the point is that the previous question that was there, in that the international transaction, that is a transaction with the AE, was with in respect of the branded goods. So the branded goods primarily would be on a higher side, whereas the comparable which was there was unbranded goods. So therefore we are giving the brand effect to that 16 crores that we got. On that price of 16 crores that we got, we have adjusted with the brand factor, because that 16 crores was for the unbranded goods. And therefore in that case we have thereafter considered the brand factor, and accordingly we have added the brand factor in this case. Unrelated party is charging royalty. then you have to see in this case what has happened in the international transaction. Based on international transaction only, you have to see. So what unrelated party does, that is one thing. But what is done in the international transaction, only on that basis the adjustment has to be done. So all you have to ensure that whatever is the ALP that you determined, that ALP has to be aligned to the same particular factors which are there in the A transaction. Isn't it? And that is what we have to do it. So question 452, students, which is about the multi-year data. Now, if there are common factors, then in that case there is no adjustment required. Okay. Now, students, coming on the multi-year data as a concept, all of you will pay attention to this one. This is a very important part. Students, in the comparable, directly up till now, we have been getting the comparable information straight away. We were being told that, look, this is the comparable price, and thereafter on the comparable price or the comparable margin, whether it is a comparable price or whether it is a comparable margin, we used to then make what? The comparable adjustment. We were being given the comparable price or the comparable margin, and on that comparable price or the margin, we were then making the comparable adjustment. That is what we have done up till now. All of you will agree to this one, isn't it? Now, accordingly, students, but what in this case, if you have the comparable data of the current year and also you have the comparable data of the earlier year also. Now, we have encountered two questions in the last lecture, in which case the cup method was applied. And if the cup method was applied, the two questions that we have considered in this case, we have been given the comparable information, the comparable data of not only the current year but also of the last year. So the comparable data was being given to us not only of the current year but also that of the last year. So both the comparable information was being given to us, isn't it, students? Both the comparable information was being given to us for both the years. But I told you specifically that please ignore the last year data. The cup method was the question. The question that was there was of the cup method. And I have told you specifically that don't consider the last year data, ignore it, only focus on the current year data. Why I had told you, now please pay attention. Students, there are three methods that you have to be very careful about it. One is the cost plus method, another is the resale price method, and the third one is the transaction net margin method. Now, in these three methods, students, be careful. In these three methods, students, if at all, in these three methods, students, if at all, you will be getting what, students? In these three methods, students, if at all, you will be getting in this context what? You will be getting in that particular context, students, the entire aspect of the current year data plus the last 2 years data as well. Then you have to be very careful about this one. They say that we have to do the weighted average. Whenever these three methods are there, then the comparable, if you have identified based on the current year, then kindly check that whether the same comparable also have got the data of the last 2 years or not. And if the comparable has got the data of the last 2 years also, then please consider the last 2 years data as well. Then please consider the last 2 year data as well and make the weighted average. And how the weighted average has to be done, this I'll show you in the case study. But a thought I just need to put across to your mind is this, that why is it that they are only considering multi-year data for the three methods? Which are the three methods? Cost plus method, resale price method, and transaction net margin method. Why is it that for these three methods that they are using the weighted average concept? There is a reason for that. Students, please understand, these three methods has got one thing which is common. Can you tell me what is that common thing in this three method? One is the cost plus method, another is the resale price method, and the third one is the transaction net margin method. What is the common thing as far as these three methods are concerned? Quickly, students. In this three method, students, you will find that they are talking about the margin. The margin percentage is the game so far as these three methods are concerned. Did you all got this one? The margin percentage is the real game so far as these three methods are concerned. And that is the real game, students, that you have to be very careful about it. Now, when I say the margin as a concept, student, all of you will be very careful about this. So far as the margin is concerned, margin is a function of two factors. Now, which are those two factors? One is the cost, another is the selling price. So, whenever you talk about the margin, it is always the function of two factors. One is the cost and another is, students, the selling price. Now, just imagine, because these three methods are dependent on the two factors. See, cost plus method, if you talk about the cost plus method, then the cost plus method only focuses on the absolute value. Do you agree to this one? The cost plus method, students, is only focusing on the comparable uncontrolled price method. The comparable uncontrolled price method is only about the absolute value. And on that absolute value of the comparable, we do the adjustment of the uncommon factor so as to determine the ALP. But when it comes to the three methods, namely resale price method, your cost plus method, or the transaction net margin method, in these three methods, the entire game is that of the margin percentage. And as I told you just now, the margin is a function of two factors, and the two factors are the cost and the revenue, that is the sales. So just think logically, students. Now there are some like COVID times and all, wherein in that case there was a pressure on at least one of the element would have a pressure. Like say for example, maybe they cannot raise a selling price beyond a particular level, but the cost was high. So these are the pressure, and that will have the impact on the margin. So even if it is a comparable uncontrolled transaction, still the margin that we may take, if the data is only of 1 year, that margin may not be, students, that margin may not be primarily what? Correct margin, because of some sort of an or maybe an exceptional circumstances in which we all are operating. There was a Ukraine war, so that also has the artificial impact on various prices also. That may not show the correct picture of that particular transaction. Artificially, the transaction has the impact in that case, although the transaction is an uncontrolled transaction. So therefore, in order to ensure that the margin which we have to take for these three methods, that margin does not suffer from any exceptional factor which prevails at the current year, therefore they say that let's try to take a weighted average of the current year plus the last 2 years, so that if at all there are some exceptional factor which is performing in the economy, if there is any exceptional factor which is operating in the economy, then that exceptional factor will get reconciled. That exceptional factor, students, will get reconciled with the margin, with the 3 years data taken together. So if the 3 years data come together, then these exceptional factor, students, will be taken care of, isn't it? And that is the reason why, students, that is the reason why this particular question, this particular multi-year data is to be considered whenever the three methods are in operational, and the three methods are cost plus method, resale price margin method, and the transaction net margin method. Is that point clear to you? Now, how do we operate that? How this particular thing work? We will see through this question. One question I will do in the class, one question will be for your homework. Okay. So let's do one question at least here in A Limited, an Indian company, is distributor of beauty product manufactured by B Limited, an associated company resident in USA. A Limited sells product to independent enterprise in India, students. A Limited is selling the product to whom? To independent enterprise in India. And further, what they have given to you, students, it has not undertaken any market development activity for the associated enterprise, nor has it added any value to such products. So, students, by virtue of this information, can we say that resale price method is what is followed? By having this particular sentence, we can easily come to know that it is a resale price method, students, which is in operation, isn't it? That exactly is the point, students. Now, what they say over here, the resale price method was found to be the most appropriate method, taking into the consideration the factor prescribed for selection of most appropriate. Students, even if they would not have given this particular reference that the most appropriate method is the resale price method, still I would have taken, students, still I would have taken the resale price method as the basis of my further computation. The resale price method as the basis of my further computation. Do you all agree to this one? All of you? Now further, please see. During the financial year 21-22, it earned a gross profit margin of 2% in transaction of product purchased from the AE for resale as under. So therefore, students, you will find it over here. Now resale price, students, what they are saying? Resale price is 102. Now cost of the product which is purchased. So this is what we are questioning, that you have purchased from your AE at a price of rupees 100. This is your international transaction and this is your transfer price. That is the price at which the goods are being procured, which is 100. So this is what is the question that we have to check, and then we have to arrive at the ALP, and once the ALP is arrived, compare this with this particular part. Gross profit, students, is 2. Now the gross profit percentage, students, is 2%. Can you see that? The gross profit percentage, students, is a 2% in this particular case. Now then, now this is not a solution, by the way, students. I must tell you, many students will be wondering, sir, this is a solution. No, students, this is not a solution. This is actually a running question. So please consider this as a case of a running question, students. Don't consider this to be a case of a solution. This is a running question which has been there. So now, in this regard, the arm's length price of the product purchased from the associated enterprise is required to be determined from in the following steps. The arm's length price of the product purchased from the associated enterprise, students, is required to be determined from in the following step. Now students, see herein. Now these are the data given to you. This is a part and parcel of your question itself. Again, I am repeating this point, students. This is a part and the parcel of your question itself. So what they are mentioning to you here, the comparable has been given to you, 127. Name of the comparable also has been mentioned to you, students. Now there is a current year and then there is the last 2 years, preceding 1 year and preceding 2 years. Now see how the things goes here, students. The comparable is 7. You have been given the current year data. Now in the resale price method, we require of the uncomparable control transaction. Students, please pay attention. In the resale price method, what we require is the gross profit margin as well as the sale price of all the comparable, the gross profit and the sale price, because through that I will be in a position to arrive at the gross margin percentage of the uncomparable transaction. I will be in a position to arrive at what? The gross profit percentage of the uncomparable transaction, and that exactly is the point. So students, this is the data which has been given. Now how do we have to arrive at weighted average? How the weighted average has to be arrived? Please have a look. To arrive at the weighted average, students, over here you can see all the gross profit, whatever is there, you need to add the entire gross profit amount and divide the entire gross profit amount with the total sales value. Add the entire gross profit amount, students, with what? With the total sales value. So the total sales value, whatever it is in this case, that is what has to be added. So in the first case, it is, say, 35 plus 10, 45, 57. 57 divided by what, student? 475. 475, students. So in that particular case, 57 divided by 475. Can you get 12%, students? 57 divided by 475. It should be 12%, students. Fine. Now, more importantly, I want your attention to be drawn on this point, the comparable number D. The comparable number D, students, is my concern. Comparable number D. Please have a look. What happens in the case of comparable D? There is a loss for preceding year, number 1. So question arises is that when we have to take a weighted average, are we supposed to consider, if we have to take up a weighted average, students, are we supposed to consider even the negative item as well? Are we supposed to consider even the negative item as well? To that the answer is yes. We are supposed to consider even the negative item, students, in this regard. So if you see over here, 22 plus 20, 42, 42 minus 9, 33. 33 divided by what? So 33 divided by 550. If you do 33 divided by 550, students, you will definitely get 6%. 33 divided by 550, students, you will definitely get 6%. Did you all got this one? Now let's take the discussion further. So that way, students, you have to do the weighted average. Add all the margin and add all the sales, and thereafter the aggregate margin divided by aggregate sales should give you the percentage. Now that way, students, now you have got all the margin percentage. 12%, 8.2, 9%, 6, 2.2. Thereafter 11.9 and 10.57. Now once you have got the margin percentage, this is a time when you will be required to now construct the data set, because the range concept will be applicable since the comparable size is 6 or above. So wherever the comparable size is 6 or above, the range concept is what will be applicable. And now with this range concept, students, you can see easily herein 2.2, 6%, 8.2, 9%, 10.5. So I have to arrange the first step, students, in the range concept. As you all are aware, you have to arrange the data in the ascending order. The data set has to be arranged in the ascending order, lower to the higher. And once that has been done, then you come to the first one, 35% of the data set. So 35% of the 7 is 2 point something. 2 point something means 3. And then 65% of 7, which means 4 point something. If it is 4 point something, it is 5. So on 3 and on 5, students, on 3 and on 5, what is the percentage? 8.2 and 10.57%. That is the percentage which has been mentioned it. Against this percentage, what is the percentage, students? Against this percentage, students, what is the percentage that you have? Against the percentage, students. What is your particular percentage, students? What is your particular percentage, students? 2% only. Are you falling within the range? You have shown only 2%, students. So you can see for yourself, students, and tell me one thing. are you falling within the scope of that range? No. Yours is only 2%. Means your margin, your resale margin is only 2. Whereas minimum resale margin we were expecting of 8.2. We were expecting of 8.2. And yours is only 2%. It implies that in this case, students, your margin, since it is not falling within the range, accordingly we will take up what? 50% of the data set. So 50% of data set means 50% of 7. It is 3.5. Of 3.5, the next number of 4. At 4, how much is the margin, students? At 4, the margin is 9%. At 4, the margin is 9%, students. Can you see that? So 9% happens to be the margin, students, over here. Isn't it? Now 9% is the median. So therefore it is a margin. Now accordingly, students, you will have to calculate the ALP. So therefore the margin that will be considered from the unrelated party would be 9%. And at 9% you will apply this on the resale price made by the Indian AE. So what is the resale price made by the Indian AE, students? You can see 102, I suppose, isn't it? How much was the resale price? 102. So on this 102, you will reduce with what? With the resale price margin of uncontrolled transaction that you have already determined as per the range concept, which is 9%, and therefore 102 minus 9%, this gives you 92.82. So 92.82 should be your purchase price. 92.82 should be your purchase price. As against this, how much is your actual purchase price, students? As against this, how much is your actual purchase price, students? So your actual purchase price, students, in this case is, you can see, students, over here, your actual purchase price is 100. So you should have purchased at 92.82, whereas you have purchased at rupees 100. You should have purchased at 92.82, whereas you have actually purchased at rupees 100. So therefore the difference, how much is the difference? 7.18. The difference 7.18 finally will become the transfer pricing will be the adjustment that has to be done. The difference of rupees 7.18 will be the adjustment that will be required to be done in this regard. Is that clear to all of you, students? Every one of you. So therefore this is what it is. So students, I have done with one question. One question is your homework, which is 453. So students, 453, please do ensure to do that, and that will help you to practice. I don't expect that the ICA will ask you such a big question. But what it could be, it can be MCQ, integrated case studies, or something of that sort. It can be anything. So at least be conceptually clear as to how the concept of multi-year data has to be applied. This multi-year data, students, as a concept has to be applied for the 3 methods. Which are the 3 methods? Cost plus method, resale price method, and thereafter the transaction net margin method. The cost plus method, resale price method, and the transaction net margin method. In these 3 cases, you will have to take up the comparable on the basis of the multi-year data. The comparable has to be taken on the basis of the multi-year data. But what if, students, what if it is a cup method? Then what happens? What if, students, if it is a cup method, then for cup method, will you apply the multi-year data concept or not? For the cup method, will you apply the multi-year data concept or not? And the answer is no. For the cup method, only the current year data is what would be applied. For cup method, only the current year data, students, is what would be applied. I hope that all of you are clear with this one. In which very case I come to now the next question, which is question number 454. Now this question, students, is based on the secondary adjustment under section 92C. I think all of you are aware of the secondary adjustment. Are you all aware of the secondary adjustment, students? Now what happens, students, as far as secondary adjustment is concerned? So if your primary adjustment, students, if your primary adjustment that has taken place, if that primary adjustment, what is primary adjustment? The ALP minus the transfer price. So if the ALP minus the transfer price is more than rupees 1 crore, then students, you will definitely add back that particular difference amount as a part of the total income of the SSE, the Indian SSE, and on which you will ask for the additional tax liability. That is one thing. But apart from that, students, the other particular part is, what is the other particular part? That since the difference is more than rupees 1 crore, the government will also expect from you, students will also expect from you that you need to bring this money back in India. You will have to bring this money, students, back in India. And that money should be brought in India within the period of 90 days from the relevant date. The money should be brought in India within the period of 90 days from what? From the relevant date. Now you will say, sir, what is relevant date? Now I'll tell you what is the relevant date. Only 2 or 3 relevant date, students, you should remember it. 3 relevant date, students, you should be remember it, and from that relevant date you will count 90 days. And in that is a period of 90 days by which you should be bringing this money in India. And if there is a failure to bring this money in India within this 90 days period, then the difference amount, students, will be considered as what? As a deemed loan. The deemed loan which has been given by the Indian A to the non-resident A. So that would be the deemed loan, and on that deemed loan there would be a notional interest that would be charged. On that deemed loan, students, there will be a notional interest that will be charged. And that notional interest that will be charged will depend upon what? This notional interest that will be charged will be for the period. For which period, students, the notional interest will be charged? I'll give you 2 options. The period is after the expiry of 90 days. After the expiry of 90 days, that the notional interest will begin, or from the relevant date itself, that the 90 days period will be after the expiry of 90 days, that the interest will begin, or from the relevant date itself the interest will begin, where the SSE has failed to, what? Failed to do the recovery within that period of 90 days from the relevant date. What is your take, students, in this case? Praising? Indeed, praising. It will be considered, students, although the law provides you this buffer of 90 days from the relevant date. That is a buffer which is provided by the law. Okay, you can recover the money within the 90 days, but if you fail to recover the money within that particular 90 days period, then the interest calculation, students, the interest calculation will then be considered from the relevant date and not from the expiry or after the expiry of 90 days. Is that clear to all of you? Now, how much is the interest that will be charged? What will be the rate of interest that will be charged? That will depend upon, that rate of interest will depend upon whether the transaction was denominated in INR or whether the transaction was denominated in the foreign currency. Because if it is denominated in the INR, then whatever is the SBI base rate as on the 1st of April of the previous year. So if your previous year is 21-22, then as on the 1st of April of 2021. So from that particular date, if the international transaction which has been entered, if the international transaction, students, which is entered on the basis of, if the international transaction, students, has been entered in this context on the basis of what? Indian rupee, then the SBI base rate as on the first day of the previous year, and from that SBI base rate you will add what, students? 325 basis point. This is the 325 basis point where the international transaction is denominated in INR. But if it is if the international transaction is denominated in the foreign currency, then the LIBOR rate, students, then the LIBOR rate is what would be applicable, and the LIBOR rate would be further enhanced with what? 300 basis point. The LIBOR rate would be enhanced with 300 basis point, and that is how the rate of interest has to be calculated to be applied on that difference amount, and the interest will be calculated from the date, from which date? From the relevant date itself, and not after the expiry of 90 days. Is that clear to all of you? Every one of you are clear or not in this context? If you are clear, then this leaves us to the last concept of secondary adjustment. And friends, what is the last concept? The last concept of the secondary adjustment is what is the concept of relevant date. I told you that you have to remember the 3 relevant dates at least. And the 3 are, say for example, if the assessee himself has done the suo motu adjustment. If the assessee himself have done the suo motu adjustment, in that particular case, the relevant date to be considered would be the due date of the filing of the ROI. So whatever is the due date of the filing of the ROI, that would be the date that has to be considered in this regard. That is the due date of filing of the ROI. Fine, students. So that is point number 1, which has to be considered over here. Second particular point, students, would be careful, students, here. If supposingly the assessee has not done a suo motu adjustment, so what assessee feels is that his transfer price is correct, he did not do any suo motu adjustment, and subsequently, students, now be careful, and subsequently the AO passes the order. Now there can be 2 things only. The AO order is something which the assessee is convinced with and he does not prefer any further appeal, or the assessee is not satisfied with the AO's order and accordingly he is trying to prefer an appeal. So in the first case where he does not prefer an appeal, then in that particular case the interest rate that would be considered, students, would be from which date? The date would be then the date when the order was passed by the assessing officer. The date when the order was passed by the assessing officer, that is the relevant date that has to be taken into account. And the last one, students, supposingly if the assessee does not believe in the, if the assessee does not, students, wants to go with the order passed by the AO, then definitely in that particular case what will happen? If you don't want to go with the order in this context, students, of the AO, then in that case they've said that fine, then it means that you want to go for litigation further. So let the court order come. Let the court order come. Which court? In this context, students, the court order, which generally will imply the ITAT order. So let that order comes, and once the order has came, then thereafter, students, what we are going to do? Once the order has came, students, in this context, thereafter that order has to be accepted. Now the assessee does not have any chance once the court intervenes, and in that particular case, the decision of the order of the court will then be considered to be the relevant date, and thereafter the interest would be calculated. Thereafter onwards, only the interest would be calculated. I hope that all of you are clear with this one. So 3 relevant date, students. It is a live. 3 relevant date I had told to all of you, and the 3 relevant dates are the due date of filing of the ROI, where there is a suo motu adjustment. Second relevant date, students, is the date of the order passed by the AO when the assessee accepts the order passed by the department, and the third one is the due date, students. The third one is the due date when the appellate authority passes the order in those cases where the litigation exists, and that is the date that we will be considering in this regard. I hope that every one of you are clear with this one. Fine. Now on this backdrop, let's have a look to this question. I want first all of you to read this question carefully. All of you students, quickly. Beautiful question. Thank you, praising. Tomorrow's students, today and tomorrow, you will find maximum coverage would be done. Because assessment procedure also will get completed. In fact, PGBP also is going to get started. Compiler, I'm talking about the compiler part. So students, stay tuned for the today's and tomorrow's session, being very important class. And as tomorrow would be one of the marathon lecture, students, tomorrow morning from 6 o'clock till 4 o'clock. From 6 o'clock morning till 4 o'clock. Did you all got this one? So that is the lecture duration for the tomorrow session. So you can just imagine we could cover up everything. Morning 6 o'clock to afternoon, evening 4 o'clock. Pray. In between breaks would be there, don't worry. So that whatever is the loss that has taken place like this week, so we will be in a position to cover up the ground. And before the results are out, students, before the results are out, we would be in a position to complete. We will be in a position to complete our compiler session fully. Tomorrow would be your, see today 5:20 p.m. also you've got lecture. So transfer pricing would get over. 5:20 p.m. also you've got lecture. So transfer pricing would get over today evening. Tomorrow morning, assessment procedure would be started. And also your assessment procedure also will get over. PGBP will get just started, students. PGBP will get just started. No, it is a compiler only, students. It is the compiler only. Okay. Now let's start with this. Students, because that way the coverage will be there, na? Completing compiler, we will not be in a position to complete the compiler, but assessment procedure topic will get over. Okay, that topic, assessment procedure, appeals, revision, rectification, recovery. So that topic will get over. After that topic, penalty, I'll not do it right now. Then I'll switch to PGBP. And say PGBP will be done. We'll start with it. I want to keep the 3 topics for the end, and the 3 topics will be charitable trust, TDS, TCS, and penalties. These 3 topics will be done at the end. Which are those 3 topics? Charitable trust. So that will be around 15th or 20th of July. Between 15th or 20th of July, the 3 topics: charitable trust, TDS and TCS, and penalties. Because that will help you to remember, because there are many rates, na? Students keep forgetting. So therefore, these 3 topics towards the end. So this is how the flow would be given. And they are also, yes, important topic also equally. So now students, let's start with this question then. Vishnu Polymers Limited is an Indian company having transactions which are subject to transfer pricing regulations. In June 2021, the assessment for should be pricing. Yes. 20th of July. In June 2021, the assessment for AYs 2021 and 21-22 were concluded after the due process under the law. Were concluded after the due process under the law. Let's have a look. In both the years, in respect of the transaction with its associated enterprise, the ALP had been determined in euro. So students, it is a foreign currency. It is a foreign currency. So in both the years, in respect of the transaction with its associated enterprise, the ALP had been determined in euro. For assessment year 21-22, the primary adjustment as translated into INR was rupees 90 lakh, students. Was rupees 90 lakhs. And for the assessment year 21-22, the same being rupees 2.4 crores. So they have given you this particular part now. So for AY 21-22, the primary adjustment as translated into INR was rupees 90 lakhs, and for AY 21-22, the same being rupees 2.4 crores. So that is what it is. Now you tell me, students, one thing. Whether for assessment year 21-22, will there be any secondary adjustment that will be required to be done for assessment year 21-22? Will there be any requirement to do any secondary adjustment, students? Quickly! Will there be any requirement? Why? Praising. Be careful. The adjustment that has happened, Prem, is of 90 lakhs. And what did I told you? To do the secondary adjustment, the difference between the ALP and the transfer price should go beyond rupees 1 crore. Go beyond 1 crore. And that is the reason why, students, no secondary adjustment will be done under section 92 CE. I hope that all of you are clear with this one. Further, students, and for assessment at 21-22, the same being rupees 2.4 crores. So AY 21-22, the next AY, students, how much is the amount that they are reflecting? 2.4 crores. Can you see that? Students, 2.4 crore, students. So students, with that particular point, at that particular point, tell me one thing, for assessment at 21-22, yeah, that is, adjustment is not been. You can just change from this particular part. Make this as 21-22. Just a second. Hold on. Okay, friends. And for AY 21-22, the same being rupees 2.4 crores. The same being rupees 2.4 crores. Clear? Now the assessment order was passed on. Okay. The assessment order was passed on 12th of June 2021, students. The assessee is inclined to accept the same and not prefer any appeal. So students, what is the relevant date? Can you tell me what is the relevant date in this case? So the relevant date, students, in this particular case is rupees 2.4 crores. Do you all agree to this one or not? The relevant date, students, in this particular case is rupees 2.4 crores. I hope that all of you are clear with this one. Isn't it? That exactly is the point. Now, after that, what they have mentioned, the assessment order was passed on 12th of June 2021. The assessment order, students, was passed on 12th of June 2021. The SSC is inclined to accept the same and not prefer any appeal. Fine. So, I told you the relevant date is the date of the assessment order. Now, let's take the next one. You are required to answer the following in light of the above. How will the quantum of primary adjustment be treated in the books of accounts of the SSC vis-a-vis a secondary adjustment? And how will the aforesaid completed assessment will impact the SSC? So, how will the quantum of the primary adjustment be treated in the books of the SSC vis-a-vis a secondary adjustment? So, students, it is just a theory. And how will the aforesaid completed assessment will impact? So, in that case, the SSC will have to face the consequence of secondary adjustment. All that is a theory, right? The theory is what is required in point number 1. Point number 2, what steps are to be taken to prevent the secondary adjustment? What you have to do, students, if you have to prevent the secondary adjustment, bring the money back in India within 90 days period. Bring the money back in India in 90 days period, students, isn't it? Will there be any secondary adjustment in the hands of the SSC if the required steps are not taken? Will there be any secondary adjustment in the hands of the SSC, students, if the required steps are not taken? Why not? Yes, there will be. Students, there will be a secondary adjustment and you are required to outline the concept. So, this is only the concept. Now, the practical is third. Calculate the secondary adjustment for previous year 21-22, assuming that the money hasn't been repatriated during that period. Now, students, you tell me one thing. In this context, you can easily see the relevant date is 12th of June. The relevant date is, students, 12th of June. So, if the relevant date is 12th of June, then in that particular case, what we will say, students, quickly tell me this. With the relevant date of 12th of June, students, please tell me quickly in this regard. What is that we are going to say about this? So, students, we will say in this regard that from this date the interest will begin and not after the expiry of 90 days from 12th of June. The interest will be calculated from 12th of June and not after the expiry of 90 days from 12th of June. Is that clear to all of you? All of you are clear with this one? And that exactly is the point, students. That exactly is the point. Fine. So, therefore, the interest has to be calculated from this particular date. The next and the most important particular part of my discussion now is this. Be careful. When you have to calculate the interest, students, now that is the point, students. Hear it. No, from 12th, praising 12th. Now the question all of you over here is this, that in this case, whether this 12th of June, students, whether this 12th of June also would be considered while calculating the number of days for which the interest has to be computed. See, they have used the word from the relevant date. From what? From the relevant date. And please tell me, students, what is this from the relevant date? The relevant date here is 12th of June. So therefore, 12th of June also should be considered. If it is from the relevant date, in that particular case, in this context, even 12th of June. So whenever the word is from, even this date has to be considered. So you will consider even 12th of June for the purpose of interest. And definitely, since in the entire year, you have not received the interest, so it is up to 31st of March. It is up to 31st of March. So you can see over here, students, in this context. In the month of June, can you see? June is 19 days. So I have counted from 12th of June. So June becomes 19 if I have to count from 12th of June. June will become 19, August 31st, July 31st, August 31st, September 30, October 31st, November, December, Jan, Feb, March. So 293 days divided by 365. Yes. Now, students, there is a facility to pay one-time tax and exit. Are you aware of that? There is a facility to pay one-time tax. Instead of every year suffering the addition of notional interest, you have a facility to pay one-time interest and make an exit. And that facility, students, is, in this case, pay 18% plus 12% plus 4%. 18 plus 12 plus 4. Or may I say flat 20.9664%. 20.9664%, students, pay 20.9664% flat and make an exit. 20.9664% of what? Of the difference. What is the difference? Difference is 2.4 crores. The difference is 2.4 crores. Pay 20.9664% on this 2.4 crores and make the exit, students. Fine, students. So this is what it is. Now, students, one question is for your homework. This small question, Yokohama, please ensure to do this question as a homework. We have done the best question. So this question is a more simpler one. So you can just do this question and that should be all. Okay. Now, students, I'll meet you at 5:20. And before that, students, one important announcement. 5:20, we will finish it off in that 5:20 session, the transfer pricing provision. One important announcement, students, as you all are aware in this context. Unacademy subscription, 20% off on all the CA subscription, students, from June 27th to June 30th. So, students, tomorrow is the last date. And this is the 20% off on all the CA verticals, meaning thereby CA Foundation, CA Inter and CA Final. Just you need to do is that you need to put up the code CADS. CADS is the code, students. That is the code that needs to be put up, and 20% discount, students, would be available. So, students, just let your friends, juniors, relatives, colleague know about the same, whether their attempt is in November 22, May 23, November 23, May 24, and let them take the benefit of this particular limited period 20% discount offer. Just remember to tell them they need to put up the code CADS, referral code, so as to get this 20% discount. Is that clear to all of you, students? Fine. So now I see you at 5:20 p.m. students. 5:20 to 7:45 would be the timing, and we will finish it off, the transfer pricing, students. Okay. So therefore, let's catch up then in the evening. Take care, students. Bye-bye. Prem, praising.